Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are down today. Dow Jones is down 1.3%. Nasdaq is down 2.2%. S&P 500 is down 1.6%. Russell 2000 is down 2%. Oil price also down 3% or $2 a barrel to 67. Yield curve plunged today across the board. 5-year Treasury yield is down 18 basis points. 10-year Treasury yield is down 13 basis points to 4.23, and 30-year Treasury is down 7 basis points to 4.81. You can see here a slew of data that came out today, way worse than expected in terms of jobs figures. We're going to go into details. I'm going to skip that for now. Let's look at the S&P 500 map. Microsoft down 2%, Nvidia down 2%, Amazon down 8% after poor AWS margins. Apple was up earlier today, is now down 2.4%. Meta is down 2.7%. Tesla is relatively flat. Google is down 2%. Financials are down across the board. Healthcare is up, and consumer defensive stocks are up. Let's read the daily article. Wall Street sell-off sparked by tariff onslaught, weak payrolls. Wall Street's main indices led a global sell-off on Friday as new U.S. tariffs on dozens of trading partners weighed on sentiment, while a weaker-than-expected payrolls report added to risk aversion. Just hours before the tariff deadline on Friday, President Donald Trump signed an executive order imposing duties on U.S. imports from countries including Canada, Brazil, India, and Taiwan, even as countries scrambled to seek ways to strike better deals. Data showed U.S. job growth slowed to more than expected in July, while the prior month's report was revised sharply lower, pointing to a sharp moderation in the labor market. Every day is quite shocked at how large the downward revisions were for both May and June. Both S&P 5 and Nasdaq were on track for their worst single-day performance since April 21. Further weighing on markets, Amazon dropped 8% after the company's growth in its cloud computing unit failed to impress investors, while lagging its AI-focused rivals, Alphabet and Microsoft, that reported on Wednesday. The stock weighed heavily on the Consumer Discretionary Index, which led the sector losses by falling 3.5%. 9 of the 11 S&P 500 sector indices were trading in the red. Apple posted its current quarter revenue forecast well above Wall Street estimates, but CEO Tim Cook warned U.S. tariffs would add $1.1 billion in costs over the period. The stock edged 2% lower. Most major mega cap stocks fell. We talked about that. Let's move on to, we're going to talk a lot about jobs market today. So sit back and enjoy the show. Little news on Tesla front. We have a couple of EV related or battery related news towards the end, but today is mostly about the jobs market. U.S. labor market adds 73,000 jobs in July, while May-June reports see larger than normal downward revisions. The latest monthly jobs report showed the U.S. labor market added fewer jobs than expected in July, while the unemployment rate moved higher. And revisions to prior months' numbers revealed significantly fewer jobs had been added than initially thought. The U.S. economy added 73,000 non-farm payrolls in July, less than the 104,000 expected by economists. The unemployment rate moved up to 4.2% from 4.1% the month prior. In line with economics expectations, I don't think that's necessarily true, though, because if you take this out, there's a reason why you don't take these things out to 2-3 decimals because of the margin of error and all that stuff. But this was very close to 4.3, just as a asterisk on this 4.2. I think it rolled out to 4.248%. So just like, and that happened despite a drop in labor participation rate. If the labor, we're going to talk in a little bit, but if the labor participation rate hadn't dropped, especially in recent months, this number would be much higher, as you're going to see in about 5-10 minutes. In its release, the BLS said downward revisions to the May and June jobs reports were larger than normal, with those changes showing more than a quarter million fewer jobs were added to the economy over those months. May's job gains were revised down to 19,000 from 104,000, while June's additions were cut to just 14,000 from 147,000 initially reported. By the way, it should be noted that in May, June, July, the stock markets surged. I mean, they had a V shaped recovery. And despite that, job additions were anemic. I mean, this is lower than stall speed, actually. The July jobs report was much weaker than expected and raises the odds of a Fed rate cut in September. Oxford Economics lead economist Nancy Van Houten wrote in a note to clients. The increase in non-farm payrolls in July was softer than anticipated, but the real story was the revisions that wiped out nearly all job gains in May and June. Average hourly earnings, by the way, so this right here, actually, we talk about it later. Average hourly earnings in July rose 3.9% over the past year. This is huge. I mean, this is still above what is in line with 2% inflation. So I think the Fed is in a tough position right now. I wouldn't want to be in Powell's shoes today. And 0.3% over the prior month. Economists expected wages to rise 0.3% over the past month and 3.8% over the prior year. So the wage growth actually came in higher than expected. Meanwhile, the labor force participation rate fell to 62.2% from 62.3% from the month prior. I think that was expected to increase, actually. The latest labor market data was released just 2 days after the Federal Reserve opted to hold interest rates steady at its July meeting. The Fed Chair Powell described the labor market as solid and pointed to a historically low unemployment rate as a key metric to watch when assessing the health of the jobs picture in America. I mean, that's still true, right? The 4.2% unemployment rate is still historically low and kind of on the edge of being qualified as solid. Powell admitted job creation has shown slowing, but that has come with a decrease in labor supply due to less immigration, therefore keeping the broad labor market picture in balance. Following Friday's jobs report, the probability of a September interest rate cut from the Fed surged to 67%. Actually, now it's like 80%, up from just 38% the day prior. The clear loss of hiring momentum in this report will embolden the FOMC doves, raising the chance of a September cut, Capital Economics North American economist Thomas Ryan wrote in a note to clients. Recent data has also reflected signs of the labor market slowing. On Wednesday, data from ADP showed private payrolls grew 104,000 in July, above the 75,000 expected by economists, and a rebound from the 23,000 job losses seen in June. But as the chart below shows, overall high momentum has slowed in the private sector in recent months. All right. That's a good overview of the kind of overall numbers, but we're going to dig deeper today into jobs. A game changer, economists react to weak July jobs report as rate cut bets surge. We talked about this. Revisions raised 258,000 jobs. Sarah House, senior economist at Wells Fargo, called the July report a dud in a client note titled July and the No Good, Very Bad Jobs Report. Okay. City economist Veronica Clark agreed, telling Yahoo Finance it's not so much this July number, but the massive downward revisions. Meanwhile, Heather Long, chief economist at Navy Federal Credit Union, called the report a game changer in a post on X, echoing others in saying labor market now looks a lot weaker than expected. Now, let's look at this thread by Parker Ross. This is an X thread. I just use the thread reader app to kind of put it to one page, but it's a very good thread, I think, with lots of details. So let's go through this. Another pretty jobs report today. I think this one chart sums up what's wrong with anyone pointing to unemployment as a sign the labor market is solid. If not for collapsing labor force participation since April, unemployment would have climbed to 4.9% today instead of 4.25%. Okay. Like I said, we should not take it out to 2, 3 decimals if you can avoid it. I think there should be more by asterisks as opposed to putting it out like this. But anyway, he says if the labor force participation rate had remained stable, so labor force participation rate has been declining pretty rapidly in the last 4, 5, 6 months. and in both fronts, both employment population ratio and the labor force participation. But you have to dig a little deeper into what's going on, and we're going to do that today. Labor force participation rate has dropped from a recent peak of 62.8% back in November 2023 to 62.2% in July 2025. Now, this only looks like 0.6%, but that's a massive change because the labor pool is huge, right? So you can see here both the labor force participation rate and the employment population ratio. The definitions are slightly different here, but they're both declining pretty rapidly, especially labor force participation rate in recent like 2-3 months. Okay. Back in May, it was a surge in workers exiting the workforce, driving the decline in participation. While that surge hasn't continued, flows out of the labor force remained elevated through July. Okay. So it's clear the labor market is not solid when looking under the hood of the household survey. It also doesn't exactly look rosy in the establishment survey either. Job growth has cooled to an average of just 35,000 over the past 3 months, from nearly 130,000 just back in April and 230,000 at the beginning of the year. So that's a massive, if you just look at 3-month rolling average, that's a massive decline. But the macro bulls will tell you that this was also the case mid 2024. Okay. And they have a point there. They have a point there. But I think it's much weaker today than it was last year. Okay. I think the momentum in the economy has slowed down dramatically. Also, I think immigration was helping. Now we have the opposite of that too. That brings me to my favorite metric from the establishment survey, the private job growth diffusion index, which reflects the breadth of job gains across industries. The 3-month index dropped below the 50 expansion contraction threshold back in May and remained 46.8 in July, down from 60.8 back in January 2025. But same story. I mean, micro bulls can point here that this was negative again last year, right? But this happened back in 2007, 2008. You can see here that it went negative first, then bounced, and then plunged. Also here in 1999, went negative, bounced, then plunged, right? So that is the 1 month. So if you look at the rolling averages, you can see a bit more clear trend. So what caused this bounce? Something to think about in second half of 2024. What caused this bounce right here? I'll think about that. We can talk about it later. Within private sector employment, manufacturing has been even uglier. The diffusion indices for manufacturing have been in contraction territory since early 2023, despite a brief spike earlier this year that subsequently collapsed. Okay. 3-month average job growth in this graph. All of the recent job growth is currently coming from education and health services alone. Yeah. Let's look more broadly at 3-month trends in the sector level job growth. You can't see in this graph. It's hard to read, I know. So we're going to say, okay, so the economy isn't really adding many jobs at this point, but at least wage growth is still solid, right? Well, that's generally true for private service industries, where wage growth has been roughly in line with the pre-COVID average over the past 6 months. But wage growth has dropped precipitously for goods producing sectors, which has been in contraction since 2023, as I noted in the diffusion chart below. Median monthly growth in average hourly earnings by industry. Okay. Goods producing industries plunge to 2.4%. Services, 6-month average, 3.4%. Okay. All right. I think this is the key story right here. This graph right here. Labor force participation rate. Right. Much higher last year in the second half of, even though it was kind of starting to decline, it was still pretty high, but now it's plunging. This can have various reasons, right? It can be because, for example, I think there's a decline in female participation rate. It could be because during the summer, maybe it's hard to find childcare. It could also be because discouraged workers kind of getting even more marginally attached, like leaving the workforce or not even looking for jobs. It could be, I think, employment population ratio decline can be due to baby boomers exiting. The one thing that this thread didn't mention is that the working age labor force participation rate is pretty high. The real weakness is coming in um, people in their 20s, people who graduate from school, new entrants to the labor force, not finding jobs. Okay. So that's, I think, the primary reason. And I think that's cyclical. That's not really a structural issue. That's more of a cyclical issue. So new entrants not finding jobs is a cyclical issue. So let's see what happens next month. All right. On the other hand, we had the Challenger Gray on Christmas. This is from yesterday, but we didn't talk about it yesterday. So we're going to talk about today. July 31, summer lull ends. July 25, job cut announcements spike to 62,000. Now, this doesn't seem like much, but if you look at the July job cuts for previous years, it's much less. So seasonally, it's a little higher. And we'll see if it repeats again in August. But let's read through this a little bit. There's some information here. US based employers announced 62,075 job cuts in July, up 29% from June's 48,000. It's up 140% from 25,885 announced in the same month last year, according to a report released Thursday from global outplacement and business and executive coaching firm Challenger Gray and Christmas. July's job cuts are well above average for this month since the pandemic. From 2021 to 2024, job cut announcements in July averaged 23,584. Considering the past decade, last month's announcement cuts are still above the average of 60,000. Okay. So far this year, companies have announced 806,000 job cuts, the highest year to date since 2020, when 1.8 million, but that was a one-off. It's up 75% from the 460,000 job cuts announced through the first 7 months of last year, and is up 6% from the 2024 full year of total 761,000. Now, also remember that these figures, year-to-date layoffs, don't include the effect of tariffs, right? So far, I think the exporters from other countries and some of the companies in the US, importers, are eating. So we should expect a margin contraction in Q3, profit margin contractions across the board in Q3. But then comes layoffs, in my opinion. So we're seeing the federal budget cuts implemented by DOGE impact nonprofits and healthcare in addition to government. AI was cited for over 10,000 cuts last month, and tariff concerns have impacted nearly 6,000 jobs this year, said Andrew Challenger, Senior Vice President and labor experts. Which industries are cutting the most in 2025? In July, government entities announced 3,666 job cuts, slightly down from June. Technology is the leading private sector in job cuts, with 89,251 in 2025, a 36% increase from the 65,863 cuts tracked through July 2024. The industry is being reshaped by the advancement of AI and ongoing uncertainty surrounding work visas, which have contributed to workforce reductions. Interesting. Retail announced 80,487 job cuts through July, up 249% from the 23,077 cuts announced during the same period last year. Retailers are being impacted by tariffs, inflation, and ongoing economic uncertainty causing layoffs and store closures. Further declines in consumer spending could trigger additional losses. Nonprofits continue to face mounting challenges from reductions in federal funding, rising operational costs, and persistent economic uncertainty. These organizations have announced 17,826 job cuts so far in 2025, a 413% increase from the 3,477 announced through July last year. Yeah, that's wild. Much of this surge is tied to federal budget cuts affecting both direct service providers and related support structures. But at the same time, look at this. This is 14,000 year-to-date increase as opposed to 60,000 in retail, right? So the real weak year-over-year, year-to-date, year-over-year weakness is coming from retail. Automotive, in July, automakers announced 4,975 job cuts, primarily citing tariffs. This is most job cut activity in a single month since November 2024. The automotive sector has cut 16,883 through July, down 31% from the 24,000 cuts announced during the same period last year. Why are companies cutting in 2025? Doge impact, market economic uncertainties, bankruptcies are on the surge, by the way. There's some indications I'm looking at. Bankruptcies are on the surge. Okay. Technological updates, AI, have led to 20,000 job cuts in 2025. So that's nothing compared to, I think it said 800,000 plus. So most of it is coming from cyclical purposes. All right. Where are the job cuts occurring? Interesting. So far in 2025, the East region has experienced the largest yearly increase in job cuts. I wouldn't have expected that. I would have expected more of a South. The South region reported a 34% increase in job cuts, rising from 60,000 to 80,000. Hiring announcements remain well below pre-pandemic levels. Okay, with U.S.-based employers planning to add 86,000 jobs through July 2025, compared to 73,596 through the same period in 2024. Okay. Technology hiring continues to decline, with companies in the sector announcing just 10 new jobs in 2025. All right. Lots of information in this report, but you can see this is really the crux of it right here. So this graph doesn't do justice to weakness in July versus previous Julys. I mean, you can see July 24 is the bottom, right? And you can see kind of upticked here. And this, again, this is happening despite the surge in the last 3 months in stock market. Like July 2023, seasonal low. July 2022, August, seasonal low. And yet, big uptick in July 2025. Let's see if it continues in August. Yellow flag right there. Okay. Now, let's switch to company-specific news, and then we're going to do a couple of EV battery stuff, and then we're going to call it a day. OpenAI reportedly raises $8.3 billion at $300 billion valuation. ChatGPT maker OpenAI has raised $8.3 billion at a $300 billion valuation, reports the New York Times. The deal is part of OpenAI's broader strategy to secure $40 billion this year. The oversubscribed round came months ahead of schedule, per New York Times. OpenAI initially raised $2.5 billion from VC firms in March, when it announced its intention to raise $40 billion in a round spearheaded by SoftBank. The AI giant had planned to take on an additional $7.5 billion by the end of the year, but beat itself to the punch as investors clambered to get onto its cap table amid impressive growth. On Thursday, the information reported that OpenAI hit $12 billion in annualized revenue and surpassed 700 million ChatGPT weekly active users. That's incredible. The Times today said that the number is closer to 13 billion. You know, the sometimes, like, I have access to ChatGPT, Gemini, and Grok, and sometimes I compare them, and consistently ChatGPT gives the better answers. Gemini is also up there too, and Grok is just way worse than the two. Other tailwinds include the Trump administration's AI action plan and talks with Microsoft that could help the startup reach its goal of becoming a true for-profit company. Projections to reach $20 billion of annualized revenue by the end of the year. Interesting. The Times reported the Dragoneer Investment Group, an under-the-radar investor, led the round with a startling $2.8 billion check. Many new investors participated in the round, including private equity giants Blackstone, TPG, and mutual fund manager T. Rowe Price. Other participants include Altimeter Capital, Andreessen Horowitz, Coteau, D1 Capital Partners, Fidelity, Founders Fund, Sequoia, Tiger, and Thrive Capital. Some early investors in OpenAI were reportedly dismayed by the smaller allocations they got in the round, as the AI behemoth prioritized bringing on new strategic backers. All right. Now, on the oil front, ExxonMobil Chevron profits slump on falling oil prices. But that was Q2. So I'm not sure how important this is for Q3, because in July, oil prices jumped quite a bit. Exxon and Chevron reported much lower second quarter profits as the price of oil slumped. Adjusted earnings for both giants beat estimates, but Chevron missed revenue forecast. Chevron's results were impacted by a loss in the fair market price shares of Hess, which it finally acquired following their long battle with Exxon. Okay, we're gonna skip that one. Nike Deckers on running among footwear stocks under pressure as Trump outlines latest tariff plans. New tariff rates, now formally authorized by executive order, set levels from 10% to 40% for nearly all global trading partners. I think people miss that these massive tariff rates are going to lead to higher and higher inflation rates in the coming months. And the question is, will the Fed want to look through to the other side? And I don't think the answer is as clear cut as these people betting that there will be a September cut believe. Okay. Now, a couple of Chinese EV news. Chinese EVs recover in Europe to pre-tariff market share level. We're just going to read the summary on this one. Chinese automakers surpassed a 10% share of Europe's electric vehicle market in June, driven by BYD. This marks a full comeback from EU tariffs imposed last year. Now, the one thing that's missing here is that Xiaomi is producing incredible vehicles, SU7 and U7, and those vehicles are not exported yet. So I think Chinese automakers' market share in Europe and rest of the world will continue to grow at a very rapid pace in the coming years. Maybe not in the US because of the government protectionism in the US. And CATL scores year-over-year growth in both revenue and net profit in H1 2025. On July 30th, CATL released its financial report for the first half, reporting up 7.3% year-over-year. Net profit attributable to shareholders jumped by 33% over a year earlier, while overall gross margin rose 1.8 percentage points from the previous year to 25%. Operating cash flow reached 59 billion yuan, and the company ended the period with over 350 billion yuan in cash reserves. So this company is doing extremely well. And they hold a lot of the cards, honestly. They, low-cost producer. They have many customers, as opposed to, let's say, Tesla depends on one or two barrel producers. So that's a big power dynamic there. No pun intended. All right. On that note, thank you very much, everybody. Enjoy the rest of your Fridays and your weekends, and I will chat with you all next time. Take care.